Pay tax now or pay tax later? What's up, guys? Mike back at it again from Ledgerly, CPA partner, alongside my good friend Andrew. You might see his mullet flowing around on some of these videos. I wish I could say the same, except I don't have hair. It's your favorite duo back at it again, giving you the best, latest, and greatest tax strategies. And if you love this stuff, please bang that subscribe button for weekly videos just like this one today. Okay, so pay tax now or pay tax later. What are we talking about? We're talking about retirement planning strategies. We're going to go over a few concepts today and a few case studies for those people who just have a day job, like a W-2 employee, for those business owners out there, and also a mix of both. Okay, so we're at the whiteboard, and for the most part, when we're talking about retirement planning strategies, there's two types of accounts. We have our traditional accounts, and we also have our Roth accounts. Now, what do these two accounts mean? For the traditional accounts, generally the money that you put in, that will equal a tax deduction. So we're going to call that TD. So the contributions that you're putting in are going to be a reduction to your taxable income. Now, the money that you take out, you're going to pay tax on this. So for all you high income earners out there, high net worth individuals, maybe the tax deduction is going to benefit this for you, and it's actually going to provide more value for you. However, just keep in mind that the monies that you're putting in are most likely going to compound and grow, meaning if you put $10,000 in now and it grows to $100,000, well, that $100,000 that you're taking out, you're going to pay income tax on all of that. Now, on the other side of the coin, the Roth accounts, the money that you're putting in is post-tax. So there's no tax deduction. You're already paying the tax on it. However, the money that you take out equals no tax. So like that example, you put $10,000 into the account, it grows to $100,000. That $100,000 you're taking out is tax-free. So that's the quick and dirty concept and the very high level 1,000-foot approach of the difference between traditional and Roth accounts. Now, what kind of traditional and Roth accounts are there? Well, we have our IRAs. We have our traditional IRA and we have our Roth IRA. And what does the IRA stand for? Individual retirement account. And then we also have our 401ks or our 403b. Now, these are employer-sponsored plans. So if you're a W-2 wage earner, you most likely have one of these available to you at your employer. Now, also for you business owners out there, there's also the SEP plans, the self-employed pension plans. SEP or simple. And we also have the solo 401k, one of our personal favorites. Now, the solo K can also be on the Roth side. And we'll get into that. We'll talk about the Mega Roth. Cool. So let's jump into a little case study scenario. Let's talk about a W-2 wage earner. And we're going to go over the strategy that we like to advise our clients on when they're a W-2 wage earner, or maybe they also have a side hustle too. Maybe something on the side or a single member LLC on the side. Okay. So number one, what we say is match and out. And this will be with their 401k or 403b, meaning that if your employer is matching up to, 3% or 5%, I've seen some as high as 8 or 10%, et cetera, contribute up to the match and then get out. Now, this is where you got to go back to your employer and maybe ask a couple questions. We advise to do Roth. Now, our philosophy here at Ledgerly is we want to pay tax now, and we never want to pay tax again. I don't want to have to worry about paying tax ever again. If you want that tax deduction, fine. We can always do Roth chunking. You want to learn more about Roth chunking? Go over to our other video on our YouTube page on Roth chunking. So Roth, if you can. Okay, number one, matching out. Number two, if you have leftover monies, do your budget, see what you have left at the end of the month. Number two, contribute to a Roth IRA. For 2025, that's when we're filming this video, $7,000 max. If you're under 50 or if you're over 50, 8,000. That's the max. Now, number three, I'm going to do 3A. You can go back to your 401k plan if you want to put more money into the 401k. Or 3B, if you have that side hustle or the LLC and you want to open a SEP, you can go back and do that as well. And what's a SEP? So let's say you made $10,000 of net income in your business. You can put up to 25% of that. So you can put $2,500 away and get a tax deduction for that in the SEP. Okay. Now, this is just a basic case study example, W-2 owner, maybe a side hustle of what you can do for retirement. Now, for the fun part, let's say you're a business owner. Let's say you are a S-Corp, you're self-employed, you're by yourself, you're wheeling and dealing, you're grinding, we can still implement the same strategies as above. Because as an S-Corp owner, you're not only the owner, the employer, you're also the employee. So you still got that W-2 that's going to come down to you. So you can still take advantage of all of the above. But the coolest thing here is now we can unlock the solo 401k and the Mega Roth. So the way that we love to teach the Mega Roth, it's a three-headed monster. It's the freaking trifecta of retirement planning strategy. We have our Roth IRA component, we have our employee Roth 401k, and we have our employer, our ER Roth 401k match. So for 2025, let's assume this individual is under 50 years old and is falling under the Roth IRA threshold, meaning that we don't need to do the back door. For more on the back door, again, go to the Roth chunking video. But let's assume that you can avoid the back door, you can go into the front door, and we're going to max it out. We're going to do 7K. Now for 2025, the 401k max employee contribution limit, $23,500. And now on the employer side, the employer, which is you, can match up to $46,500. And guess what? That match equals a tax deduction for the business. So yes, the Roth IRA, no tax deduction. The employee contributions, the amount that you are contributing as the employee, the $23,500, unfortunately, not a tax deduction. However, the employer match, the $46,500, is a tax deduction. So when we add all three of these together, we're looking at $77,000 of monies that you're going to pay tax on now, but you're never going to pay tax on again. Okay, so there's a lot to unfold here. But don't worry, this is not a one-size-fits-all concept. Keep in mind, you know yourself better than anyone. And the primary goal is to give you the best pair of running shoes so you can get a head start and keep on sprinting with your retirement plan strategy. So we want to take a big step back. We encourage you to do a budget before you rip the Band-Aid off and say, oh, I'm doing a Mega Roth. Let's pump those brakes, man. The big questions you got to ask yourself. How much can I afford to save? How much have I already saved? Do you have employees in your business? Are you married? Do you have kids? Can we also utilize the HSA, the health savings account? Another video in our channel for that one. Is the tax deduction, traditional accounts, going to help you now? Or should we do Roth? Or should we go Roth from the get-go? Or should we convert to Roth later? Roth chunking, that video is also in our channel. There's a lot of ifs, ands, and buts here, and it can be a big circular formula. But let's, again, pump those brakes. Let's find the best fit for you, which is ultimately our job. And with that being said, please get in touch with us because our goal is to build those retirement buckets up, or if there's a hole in one of those buckets, let's either plug it or move it to another bucket. With that being said, let's come up with the perfect mega strategy for you.